Did you know that while the agricultural income in India is tax exempt, the government still calculates tax on your income from tea, coffee, and rubber? If you own a plantation or you run an agri business, this is the one income tax aspect that affects your bottom line. It's all due to a special rule called composite income combined with partial integration. So in today's video, we are going to break down these complex rules into simple steps. Stay tuned in because if you miss this, you might end up paying more tax than you need to. Let's start with the basics. Section 10(1) of the Income Tax Act gives 100% tax exemption to pure agricultural income. Now, what's this pure agricultural income? Let's understand this with a simple scenario. Imagine Ravi grows and sells raw vegetables like tomatoes and cabbage directly to the market. His net farm income is 8 lakh. Because he's selling the produce after only the ordinary processes like cleaning and sorting, the entire 8 lakh is pure agricultural income, 100% exempt from income tax. But here is a crucial difference. When you start processing the produce, like making manufactured tea from leaves, cured coffee from coffee beans, rubber sheets from latex, or you carry out special process on any other crop that you grow, the income is no longer purely agricultural. It becomes composite income, partly business, partly farm. Since the business part is taxable, we need to find a way to legally split that composite income. For tea, rubber, and coffee, the income tax rules prescribe a fixed percentage split based on the product and processing level. If you grow and manufacture tea in India, 60% of your net income is considered agricultural, that's exempt from tax, and 40% as business income, that's fully taxable. For rubber, the split is more favorable, 65% agricultural and 35% business income. For coffee, this depends on the process. If you only grow and cure the coffee, 75% agricultural, 25% business income. In addition to growing and curing, if you roast and grind these beans, the split changes to 60% agricultural, 40% business. Now the next part, partial integration. It's how the government indirectly taxes your agricultural income. And to make use of the scheme, you need to satisfy 4 conditions. 1. This rule is applicable only to individuals like you and me, HUFs, AOPs, POIs, and AJPs. Now, if you're wondering what these abbreviations are, I have a separate video on this topic. If you're interested, you may consider watching it. The link is in the top right corner. Now, coming back, to put it differently, this rule is not applicable to firms and companies. 2. You should have opted for the old tax regime. Now, what if you opt new tax regime? We'll talk about this later. 3. Your net agricultural income should be more than rupees 5k. 4. Your taxable non-agri income should be more than the basic exemption limit, and in old tax regime, as of now, this exemption limit is 2.5 lakh. How do we calculate tax? Let's see it with numbers. Say you have regular non-agri income like salary, which is fully taxable, 5 lakhs, composite tea income, 10 lakhs. We have to first split this composite income. 60%, that is 6 lakhs, would be treated as agricultural income, which is exempt from tax, and 40%, that is 4 lakh, would be treated as business income, which is fully taxable. So total taxable income, 9 lakhs. Now let's compute tax. Step 1, calculate tax on aggregate income. Aggregate income here is non-agri income plus net agri income, which is 15 lakh here. Let's calculate tax on this. Up to 2.5 lakh, no tax because that's your basic exemption limit. On the next 2.5 lakh at 5%, 12,500. On the next 5 lakh at 20%, 1 lakh. On the remaining 5 lakh at 30%, 1.5 lakh. Total 2,62,500. Let's call this as tax 1. Step 2, calculate tax on hypothetical income. Hypothetical income here is net agri income plus basic exemption limit, which is 8.5 lakh here. And if we calculate tax on this, total would be 82,500. Let's call this as tax 2. Step 3 is the difference between step 1 and step 2, that is tax 1 minus tax 2, which is 1.8 lakh here, and this is the net tax that you have to pay. The crucial takeaway here is, had you computed tax on the entire 9 lakh, that is your non-agri income, normally without this partial integration, then the tax that you had to pay would have been 92,500. So this difference, that is 87,500, is the extra tax that you pay because of this partial integration scheme. And this difference clearly shows how the 6 lakh of exempt agricultural income pushes the entire 9 lakh of non-agri income into the higher 30% tax slab. The key concept here is the agricultural income is directly not taxed, but it increases the tax rate on your non-agricultural income. Essentially, the exempt farm income is used as a boost to push your business income into a higher tax bracket. First, choosing new tax regime is better because it explicitly ignores the partial integration concept. To understand this better, let's calculate tax considering our earlier scenario, that is non-agri income 9 lakh. In new tax regime, up to 4 lakh, no tax because that's your basic exemption limit. On the next 4 lakh at 5%, 20k. On the remaining 1 lakh at 10%, 10k. Total tax 30k. And if you may recall, in new tax regime, if your taxable income is up to 12 lakh, you get 100% rebate under section 87A. So net tax payable is 0. That's why choosing new tax regime is better. Next, Section 33AB of Income Tax Act offers a special deduction if you deposit money in tea, coffee or rubber development accounts, but you can use this only for certain specified activities. This is available only in the old tax regime, so if you are interested, you may consider this. Number 3, if you're someone who is growing crops, not tea, coffee or rubber, and you're carrying out certain special processing activities, then it is always a good idea to clearly segregate your cultivation costs from your manufacturing costs so that you can calculate your net income accurately. Finally, one last piece of crucial information for all growers. Remember that income from a nursery, growing sapling and seedling in pots or beds, is also treated as agricultural income, so it is tax exempt. To recap, tea, coffee and rubber growers, or if you have composite income, for the first year when you start earning, compare between the old and new regimes and choose what's best. Now, why first year? Because if you have business income, you can't keep switching back and forth for every year between new and old regimes. Because once you opt out of the old tax regime, you can't opt in back. So remember this restriction and choose what's best for you. That's it in today's video. Hope it was informative. Thank you for watching.